Hey everyone, it's Daniel here from InfoRest. Hope you're all doing well. I just want to talk about this concept of Fed pivot. And what we're seeing today in the markets, in the equity markets, we're seeing quite the rally in the equity markets. We're seeing since yesterday and today. And this rally comes from after having a weak ISM report, a US ISM report that looks at how manufacturing data is performing within America. And it's got different components like the employment and the prices component, which gears towards inflation. So this ISM number that came in, it came in weaker than expected. The employment component came in weak, the prices component came in weak, and it basically jolted the equity markets to move up. Now, this move that we are seeing comes after many days and weeks of a sell-off, after the Jackson Hole event, after the CPI report that we got last month, and after equities just been selling off drastically. We see a complete reversal in the US equity market. Now, why is this move happening? And you could argue that the theme of the Fed pivot is coming back in. And what is this Fed pivot, right? Back in 2020, at the bottom of March, and in 2021, a lot of the bulls, and you can see the markets really did a V-shaped recovery since the 2020 crash. And a lot of the bulls basically came out and said, hey, don't fight the Fed. Don't short the markets because you're going to get creamed, and don't fight the Fed. And the fact that the Fed pivot, is basically this concept that the Fed is going to come and save the markets in the equity markets, and the bulls are going to be happy, and everything's going to go up. And don't fight the Fed, don't fight the Fed. The Fed pivot is here, and all the way up we go to the moon, as some people would say. Is the direction where the equity markets basically went to, right? A huge, massive rally, about 100%. Actually, don't quote me on that number. I don't remember exactly, but a big rally in the equity markets. You saw a lot of stocks rally as well. Tech did very well, and all because of this Fed pivot kind of thing. Now, fast forward to this year, 2022. Again, the same bulls that were saying that, okay, this market that we're seeing, the sell-off that we're seeing, they still come into the market anticipating that the Fed's going to pivot. We're going to get the Fed pivot. We're going to get the Fed pivot. And it's been a losing trade every single time. Every rally that you've seen in this downturn has been a losing trade, because we've just been selling off, and every rally you see is a bear market rally, right? And it's normal to have these bear market rallies where you're in a bear market and the equity markets just continue to rally completely. Now, because we get a rally, it doesn't mean that, okay, this is the Fed pivot, right? Just because yesterday and today we're getting the equity markets moving up doesn't mean, okay, this is it, guys. We're going to go up and we're going to the moon and everything's changed from here. We've dropped quite a bit. Yes, I agree, we've dropped quite a bit. But it doesn't mean that the issues down the road, the problems are solved. Nothing has been solved yet, right? So this rally that I see it more of a squeeze, a short covering squeeze. I see it to be a relief rally, a temporary rally. For all the people who shorted very late, they're getting squeezed out of this position. And if you're short and you need to cover your position, what are you going to do? You're going to hit the buy button to exit out of your trade if your stop loss is getting hit, or if you're just panicking out of the trade and you were one of those shorts who are panic selling, or panic covering actually is what I should be saying. And this is what we're seeing in the markets right now. Now, this Fed pivot that is coming back in happens to be in a week where we're going to get a lot of data, right? We're going to get ADP tomorrow, an employment report. Thursday, we're going to get some data as well. Friday, we're going to get non-farm payrolls. We're going to see how the employment component is. Then later in this month as well, we're going to get CPI. And then after that, it repeats again. Every month you get a lot of these data indicators, macro data that comes out. On top of that, you have midterm elections that are coming in. Can you see the equity markets start to move up higher, in especially as midterm elections show up? Sure, definitely there could be a lot of manipulation that could come into the markets, and it could cause these temporary rallies. But that doesn't mean that the true Fed pivot is here. On top of that, we're gonna see also the Fed's language start to show that, and especially the policies start to show that the 75 basis point rate hikes that they're doing is eventually going to taper and slow down to 50 and then 25. That is expected, right? Right now, the markets are pricing in a 75 basis point rate hike for the next meeting that's coming up. However, that can change after a couple of, two CPI reports. That could change after this CPI report, after data, and so on. So definitely this can all change. And then again, you're going to get people coming in. Okay, the Fed pivot is coming. The Fed pivot is coming because the Fed is now slowing down on its rate hikes. But the Fed and every central bank out there have been explaining and saying that the job has not been done, and we still need to fight inflation. If inflation continues to overheat and the CPI data that comes out this month ends up being worse than expected, then guess what? You're going to see a massive sell-off, and that Fed pivot is going to be completely wiped out. Now, if it comes in lower, in line or better than what the market was anticipating, then sure, you're going to see some sort of relief rally, but I wouldn't call that as the Fed pivot, right? I wouldn't say the Fed is pivoting, because they're still tightening, they're still raising rates, they still want to get to 4.25%, 4.5% in interest rates, eventually maybe get close to 5% next year. And if inflation's higher than expected and it's not tapering, not coming off, then who knows, we could go higher than 5%. But definitely, as we continue to move higher and higher in rates, we're going to see pressure on the macro data. And don't forget that there's a lagging effect of macro data in terms of today's a lagging effect in terms of interest rates on the effect of on macro data. So it takes about around 6 months to see the impact of these interest rates. So the first rate hike that we had this year, we are now seeing the impact on the data now of the first rate hike. Next year, we're going to see the impact of this rate hike that we've got to up to 3% plus. We're going to see the impact of that possibly in next year, right? Just about 6 months from September. So we're probably going to see the impact coming later, but that doesn't mean that the inflation story is over as of today. Maybe down the road, and like I said, that to really get that inflation number down to 2%, to their target where the Fed wants to go to, you need some sort of ugly recession to come in, and you're seeing the signs. Credit Suisse, right? A lot of chatter on Twitter about the default scenario there, the credit default swaps that are at high levels back in 2008. A lot of people leaving the firm. They're comparing it with Deutsche Bank and so on. And then Bank of England, another scenario there where they stepped in to temporarily soften the pension fund issues. I did a video on this. You can take a look at that in my previous post. And especially that QE that the Bank of England is doing, it's going to be just temporary to soften the implications of higher yields to bring that down. And then again, once they stop, it doesn't mean that, okay, Bank of England is doing QE, so there's the pivot. Now, are we going to expect the Fed to do the same thing, to start buying bonds as well? I don't think so. I really don't think that's what's happening here. And I think the markets are kind of brushing this off, these red flags, a little bit too easily. And I don't think that all of a sudden we're going to see the Fed just start buying a bunch of bonds and doing QE. So I think there's much more to it, and we're going to see and have more answers as we approach midterm elections, end of the year, next year, and so on, especially if we see the impact of higher and higher rates. So definitely I'm still on the camp and still on the boat that there's no Fed pivot. I don't think there's a Fed pivot coming anytime soon until maybe once something breaks, which may happen. I don't know when. Maybe this year, maybe next year, maybe the year after. But when something breaks, then sure, we can start talking about the Fed pivot. But because the Bank of England is doing something, and then now the Fed's got to do the Fed pivot, or just because they're going from 75 basis points to now maybe 50 or 25, I wouldn't say that's a pivot. You're still raising rates, and I wouldn't say that you're done with the job of bringing inflation lower. And the Fed said it. They're going to bring pain for households and businesses, and they're going to continue to bring this pain. They're going to continue to bring growth down to bring that inflation lower. And it's expected that unemployment rate is going to move up. So they've mentioned it before, they've said it in their conferences and in their meetings, but yet the market is still expecting the Fed pivot. Sure, we could get it next year, but we're going to probably get it if something breaks, not just out of the blue. So anyways, these are just my thoughts on this whole Fed pivot talk. I saw an article on Fed pivot. Few people talk about Fed pivot, so I thought I would do a video. If I find that article, I'll leave the link in the description. And I hope to see you guys in the next video. Subscribe, hit the bell icon to be notified, give a like to this video, and leave a comment on what you think about the Fed pivot. All right, guys, see you around. Bye.